So if we have a bullish view on gold, then you necessarily have to be also bullish on silvers.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics at this exciting time in the market where, gee, has there been more attention and interest directed towards gold and silver? Probably at a few points in history, but certainly with what is building, I think we're in some historic times now, which makes it, of course, quite fortunate to have Ronni Stoeferle of Incrementum AG, also one of the authors of the In Gold We Trust report, which I have pulled up and we'll take a look at. Hopefully Ronni will bear with me and let me go right to the silver part. But Ronni, it's great to have you on here. I like we have video, so we get to see your great smile today. Thank you for joining me. A pleasure to have you here. How are you today?
Hi, Chris. Great to see you. If you might wonder, because some people, I'm here from home, working from home, a little bit outside of Vienna, so I'm not in the office in Liechtenstein. And many people said, "Who's that guy? Is that you running the marathon?" And it's unfortunately not me. That's the world record by Eliud Kipchoge. He was the first man to run a marathon under 2 hours, which is one of the biggest achievements in sports from my point of view. So yeah, that's what I'm aiming for.
I know you were planning on running one earlier this year. Did that ever happen? Or?
It was canceled because of COVID, of course. But I did quite a lot of running because, you know, in these times you have to clear off your head. There's so much going on. And for me, running is just, you know, the best therapy and the best thing to align my thoughts and to structure my thoughts. So yeah.
Well, maybe by the time they start those back up, you'll be ready to crack the 2-hour mark.
Yeah.
And if anyone can do it, I mean, you run funds, you write the massive 300+ page of everything anybody could ever want to know about gold, and you know all about the mining stocks. So perhaps to dig in, I mean, it's interesting what's happened since the last time you and I talked, I believe was maybe before the end of last year. Before the corona hit, before the Fed started their hyperinflation campaign, which central banks around the globe are getting a little jealous. They're like, wait a second, if he's going to do endless printing. So catch us up to speed on that and how it's hit the precious metals markets.
Well, I think first of all, it's important to say that, you know, gold was already in a bull market before. Gold hit all-time highs in basically every currency in 2019 already. Gold was up, I think, 18 or 19% in dollar terms last year. And now everybody said, yeah, gold is just rising because of COVID, and we just have this recession because of the whole COVID crisis. That's nonsense, because I think there was just a catalyst. And from my point of view, you know, last year, in our last year's In Gold We Trust report, and in many keynotes that we delivered, we said, the recession clouds are getting darker and darker, and there were many signs. You know, we saw yield curve inversion, we saw earnings recession, we saw that global trade was actually shrinking. So I think there was a very strong case for a recession. Of course, we didn't see a virus coming out of China or whatever being the trigger for this recession. But we said back then that gold is one of the best and one of the most reliable recession hedges. So last year we had a really big chapter about how gold is performing in different stages of a recession. And you know, we over here are really, you know, we like skiing and we also like football, so soccer. So I said gold is the Franz Beckenbauer of your portfolio. So it is really a solid defender. It stabilizes your game. And I think gold did exactly what it's supposed to do in the whole crisis. It stabilized and it hedged your losses on the equity side. There was a sharp sell-off, of course, but then it reacted really perfectly to all this monetary and fiscal stimulus. And And now, of course, nobody knows how it's if we're gonna see a V-shaped recovery. I don't think so. I think it's gonna be small W's. I think we're definitely not out of the woods yet. I think it's gonna be a really interesting fall. We've got the elections. Most of the polls say that Joe Biden is gonna make it, and if you have a closer look at his team, well, it's basically many guys from the Bernie Sanders campaign. So I think his fiscal policy will be, let's say, interesting. And I just see, and that makes me again a bit bearish, because I just don't see any scenarios going forward that are negative for gold. So we quoted Kirill Sokolov, and he said all roads lead to gold. And I think, it's really an investment or a hedge or a monetary insurance, however you want to call it, that you can be very relaxed about for the next couple of years probably.
Yeah, and Ronnie, I'd love to give you the opportunity here to break an American election scoop from Vienna, no less. So this is something most precious metals folks can't do. But would you go out on a limb and guarantee today, whether the Democrats or the Republicans win, that the Fed is going to print more money? And would it be correct to even go as far as to say that, based on what we've learned from Austrian economics, it's impossible for them to ever remove any, not even all of this liquidity, but almost any of it? They're going to have to print.
Yeah, it's like, I know, do you know many, how do you say, anorexic sumo ringers, sumo wrestlers? I mean, I think that, Chris, whoever's gonna win, I think that such theories like MMT, like helicopter money, like universal basic income, a couple of months ago, they were basically the wet dreams of some economists, but now they're really coming into the spotlight, and it's basically a given that something like that will be implemented. Will there be a big difference, Joe Biden policy or Donald Trump policy? I actually don't know, but I mean, actually, every politician is in the game of, being reelected. So going forward over the next couple of months, I don't expect a very hawkish Fed policy, and I don't expect a very conservative and restrictive fiscal policy. So I think, we stepped over so many lines, we crossed so many lines, we broke so many taboos in the last couple of weeks. It just doesn't matter anymore, it seems. Yeah. And those numbers, here 1 trillion and there 750 billion, nobody cares about it anymore. Recently I said in a conference call, I remember on the cover of the Financial Times when they bailed out in 2008 a small mortgage bank, and I think it was like 50 billion, and it was like a big thing. That's the end of capitalism, and how can they do it? 50 billion nowadays, that's nothing. So I think, with the Federal Reserve, now being very active in the corporate bond market, even in the real estate market, I think, this is just the next stage of our inflationism, and basically we came closer to the end game, obviously. But I'm not sure, perhaps they'll be able to reflate the system once again. But I know that, the next reflation will even have to be more aggressive. And that's my concern, because all the solutions that I'm seeing, they're more interventionist, less capitalism, less free markets. And that probably won't solve the problems and won't lead us to prosperity.
I agree it won't. And I'm careful how I say this. I actually look forward to the other side of this where, if we were using tulip bulbs and pet rocks at this point, we'd probably be better off for the people than the current system. Although something you and I have talked about before is the inflation. I'll admit that based on what happened in 2008, I'm surprised things aren't more out of control. Certainly prices have gone up. Although perhaps something I don't see people point out, I'd love to get your opinion on it. Let's say the stock market goes from 29,000 to 25,000. yes, the number has gone down, but there could be more inflation there than ever, because maybe it would have gone to 10,000 or 5,000 or 1,000 without all of that printed money. So I feel like a lot of the inflation has gone into the financial markets, some consumer inflation, but anything you could touch on there would be great.
Well, of course. I mean, if people say we don't have any inflation, it's of course the question how you define inflation. Yeah, I mean, is PCE or CPI, is this really relevant, or is it highly subjective? And how are those baskets calculated? I mean, we can talk about that for a while, but I think, you know, with this Austrian framework, first there's monetary expansion, monetary inflation, then there's asset price inflation. We had that. I mean, we're in this everything bubble, like Jesse Felder always says. Real estate all over the globe being at all-time highs, equity markets also, you know, being more or less close to all-time highs. I just saw that Tesla now has a higher market cap than Toyota, for example. We're seeing it in the bond market, of course. Yeah, you know, safe government debt being, at ridiculous prices. Austria just issued a century bond yesterday. It was massively oversubscribed. And then we're seeing it also in, you know, in the art market, but also some other type of things. Like I read it today, you remember Nirvana Unplugged, and Kurt Cobain, he wore really a ugly cardigan, and it was sold for $300,000. And his guitar, a Fender, I don't know which type it was sold for $6 million. So this already tells you, well, okay, there's lots of asset price inflation. Now, I think going forward, I think inflation is not a concern for the very short term. But I think going forward in the next couple of months or quarters, it will be a major concern. And, you know, the higher the debt levels, the bigger the desire for inflation, of course, and the bigger the fear of deflation. When you're highly indebted as a government, as a household, as a company, as a financial, whatever, you know, deflation is your worst enemy, your biggest fear. And now what happened with COVID, you know, debt to GDP ratios in industrialized countries, they rose like 20%. We're now in many countries at levels that, you know, we used to have only in banana republics. This year in the US, I think the Congressional Budget Office says 20% budget deficit. Next year, I think 9 or 10%. So those numbers are just staggering. And they also tell me, you know, the longer we don't have any headline inflation in those baskets that bureaucrats measure, the longer they will have basically room to maneuver and to extend those inflationary policies. And I think the big difference, Chris, compared to 2008 now is that it's not only monetary stimulus, but that it's also fiscal stimulus. And now it is really important to see that the governments over here, they basically guarantee the loans. So as a banker, I would say, okay, this is a rubbish loan. I wouldn't do that deal if it's my own risk. But if it's, you know, the government is basically paying for it and they're guaranteeing it, I would be stupid to not put out this loan. So I think this is really a sign that what we wrote in the Gold We Trust report is much closer alignment of fiscal and monetary policy, that this is actually happening. And just one last thing, if you saw the press conference of Jay Powell recently, he sounded like a social worker. And he really tries to bail out everything and everyone, and he wants to be a good person. That's actually not his job. So I think we saw a tremendous paradigm shift over the last couple of weeks. And yeah, so plenty of stuff to talk and to write about, obviously.
Yeah, and I mean, maybe one day, maybe in the next 5 years, we could write a book about some of the central bankers. That would be fun. And
didn't you just publish a book on silver?
I did. I published.
That's great timing. That's great timing, Chris. Congrats.
Well, we're going to get to your thoughts on silver because obviously, as I mentioned before, you are the author of, here we go, the In Gold We Trust report. And so, Ronnie, based on everything that we've just talked about and everything that you have in here, a very thorough report that anyone in the gold and silver markets should read. A great list of partners there too. So based on all of that, gold's close to $1,800 US today. And you know how us Americans are. We like buying, not all of us, but a lot of them like buying high, selling low, chasing momentum. And I mean, it's really, we're approaching something historic. I mean, it's not like Tesla sets a new high, you know, all right, fine, maybe. But when gold's crossing through 1,800 or 1,900, A, do you think that's going to happen? And B, at some point, do we see some gaps in the price? I'm curious how you see it all playing out from here.
Well, I think it's just a very, very strong bull market. It's really a stealth bull market. You know, gold is rising in every currency. It made all-time highs in basically every currency but the US dollar. It will make new all-time highs in US dollar terms pretty soon is our view. Gold is outperforming the equity market. Gold is outperforming bonds. The mining stocks are outperforming gold. The junior miners are outperforming the large caps. So those are all great confirmations. We look at long-term technical indicators like the Coppock indicator, all, you know, on green. It's really, sometimes I think this is too good to be true. Where is really the thing that I'm missing? But, you know, every small correction is being bought, and I just see that so many people are still waiting on the sidelines. They're not invested yet, and they still don't really get it. But if I talk to institutional investors, they say, okay, it's pretty obvious with the politics out there now, with, you know, no opportunity cost, because the Federal Reserve said until 2022 at least we won't see any rate hikes. So this is a perfect storm for gold, basically, and of course bull markets are more fun than bear markets, and I think it's just, you know, there will be corrections within this bull market, and perhaps if you have a look at some of the charts in the mining space, they look a bit frothy, I would say, because, you know, really parabolic move. So we might take a breather over the next couple of weeks, but I think this is a really, what you should do in a bull market is you should buy the dips. And I just don't see, from a commitment of traders report, from a sentiment point of view, of course, we're in the second stage of this bull market. We're not at the very beginning, but we're far away from this parabolic phase, from this mania phase in gold, where everybody is going crazy about gold. We have seen some signs, you know, there was, I think, Bank of America coming out with a bullish report. Goldman is slightly bullish now. So this is happening. So the gold train started moving, but it's going very slowly.
And I know in a recent interview you did, I don't know if I would call it a price target. You had a number there, and I understand the importance of phrasing those things clearly. So if you care to share that, and also perhaps another maybe more direct question, do you think we will see $2,000 gold in 2020?
I think so. Yes, I think so. You know, now we've also got the very positive seasonalities over the next couple of months. So I think we'll get there. The price target, and this is based on our model, that is basically it's a monetary model. So we said we calculate some probabilities, some gold backing scenarios. We forecast the growth of M2 in 3 different scenarios, like the 1970s, like the 1990s, and like starting at 2000. And you can all read that in the report. And it's, of course, it's not a super sophisticated model, because those super sophisticated models usually don't work. So it is a simplistic model, but I think it works. And we come to a price target of $4,800 by the end of this decade. Because in this report, we really want to explain the long-term view, the long-term picture, the most important long-term drivers. And therefore, you know, $4,800, everybody says, whoa, that's like super bullish, but that's compound annual growth rates of 10.4%. until 2030. And you've got to ask yourself, and that's probably the most simplistic question, do you think that in 2030, a US dollar, a euro, a British pound, or gold will have a higher purchasing power? Which currency will preserve your purchasing power best? And for me, the answer is pretty easy. So yeah, have a look at this model. I think it's heavily skewed. So I think that even longer, that the probability for even higher prices is higher. But of course, if we reach $4,700 at the end of this decade, it will be okay. But I think what's really important is the fact that we're in a bull market, and I don't see any major divergences at the moment.
Yeah, and I'd say at the rate the Fed's going, you might get there in the first half of the decade rather than the second. Ronnie, last one before we wrap up. I know you have a fun outing planned tonight. We want to get you on your way there. Although you knew I wasn't going to make it through a whole call without commenting on your great silver quote. So we have a chapter in the report, silver lining, and what might a future silver price look like? The current, actually, that's not there we go. We do not know what the future holds, but we would be surprised if in retrospect, silver will not have proven to be a wise investment for the next generation. Ronnie, for people who like gold, what would you tell them about silver?
I think it's a great opportunity at the moment. Chris, we are writing the In Gold We Trust report for 14 years now, and I have to say it's not only me putting out this report. We're a team of 20 people, so it's really a massive project for us, and I'm very proud of my team, but also the companies that support us, because otherwise it wouldn't be possible to put out such a report for free. But this year, it's the very first time that we wrote a special chapter on silver. My friend Emil Kalinowski helped us with this chapter, and I think it's really interesting to analyze, first of all, the supply-demand view. I think on the supply side, there are many drivers going forward for pretty positive developments in silver. I think on the demand side, investors at some point will realize, well, silver is pretty cheap, and so silver is also some sort of a sentiment indicator for gold, and at some point silver will massively outperform gold. On a relative basis, we saw this all-time high in the gold-silver ratio at 125. Now it went down already significantly, but I think we should normally go to like the low 50s or 40s in the gold silver ratio. So if we have a bullish view on gold, then you necessarily have to be also bullish on silver. So we've got this table, for example, and I think that if inflation will really become a concern, and I think inflation will be really a major topic going forward. Many people have been in the inflation camp for ages, but I think this time, and one of the analysts that I most respect in the industry is Russell Napier, and he has been a deflationist for decades basically, and he was so right. And now he says, okay, the next couple of years will be highly inflationary. So I think there's lots of reasons to think that inflation is not around the corner, but perhaps on the horizon. And therefore, I think in an inflationary environment, you want to have gold, but you want to have even more silver.
Well, that makes sense to me. And it's kind of funny. I can now say I wrote the book on it. So we'll get you a copy of that shortly, although perhaps more importantly for folks today, to get the In Gold We Trust report, you can go to ingoldwetrust.report. And Ronnie, any final thoughts just of how people can reach you? I have the report link pulled up. That will be in the description field below right there. And also Incrementum.li, where they can find out more about the funds that you run. And any last thoughts there, my friend?
No, you can have a look at our webpage. We do fund management, wealth management, and we also write lots of research. We've got advisory board calls. We publish chart books on gold. We've got In Gold We Trust nuggets that will soon be published. So lots of stuff that we're putting out, because I think it's important to educate people about sound money and about the Austrian school, and yeah, that's just important for us. And that's basically it. And I'm active on Twitter. I do post quite a lot of charts and some short comments, and also some odd Austrian music that is probably not too interesting for most of the viewers. That's basically it. And I told you I'm going to a beer garden today, and this is really what I'm looking forward to, because the last couple of weeks with the whole lockdown and everything, it's been a very demanding time. It's been a super interesting time for me as a family father, as a businessman, as an investment manager, as a researcher. I think it's been fascinating, and I wrote my diary, and I think it's really something that we'll tell our grandkids probably about. But it's been demanding, so I really look forward to go to the beer garden. And our famous gold beer ratio that we publish every year for the Oktoberfest. Actually, the Oktoberfest has been cancelled. So we
No.
have to find a new comparison for this year. So yeah, we'll have to become very creative over the next couple of weeks.
Well, I feel pretty confident that if there's anyone to find the way to express the gold to beer ratio properly, Ronnie, you're the man for the job. I thank you kindly for joining me. Go
Thanks.
get the In Gold We Trust report is the address for that. All of it's going to be in the description link below. And we'll look forward to having Ronnie on the show again soon. And folks, if you're interested in a rather intriguing development that took place in the silver market yesterday, well, that is coming your way now.